Hello, everybody, and welcome to this 2024 Q4 investor update. I'm Jeppe Kirk Bonde, the most copied popular investor on eToro. If you want to use this presentation for anything, please go ahead and read the disclaimer at the bottom of this slide very carefully. In this presentation, I'm going to go through my background, my investment strategy, what I have in the portfolio, and then through the many questions that I've received in advance. Now, one of the reasons that more than 30,000 copiers as of this week are now copying me on eToro is that since 2013, I've had an average annual return of 25% per year, which is really better than anyone you could fairly compare with, and also with a relatively good return to risk profile. If you wanted a higher return than that, you would effectively have had to take on a lot more risk. My background is from management consulting. So I did my university degree back in the day in finance. And then as I was working as a management consultant, advising some of the largest companies in the world, I was working mostly on valuations, calculating what companies are really worth. And then I was making more money than I was spending. So I wanted to invest my money. And then I compared all the different platforms, the different brokers and so forth to see which one was right for me. So I, looked at how good is the website, how good is the app, what instruments are available, what are the fees like, how is the platform developing over time, how is the security and so forth. And then eToro came out on top. And so I started investing on eToro. And then as my investments did very well on eToro, people started copying me. And then in 2018, I quit management consulting to focus only on managing my money on eToro. And then 1 year later, I was the most copied on eToro, and that's been the case since then. I don't do everything on my own. I have a great assistant who helps me. I have a good network of experts that I trust on very difficult topics. So if I have any questions or concerns about something very difficult, I'll have someone to talk to about that. And effectively, if I invest in something, I must either myself be an expert in it or know someone who is. Then I get really strong support from eToro. So whenever I have any questions or concern, then there's always someone from eToro who can be really quick to help me out. And finally, I subscribe to all the best data providers and have the best IT tools available so that anything that sort of should be automated is automated. And finally, I'll highlight my favorite experts, which are my three brothers. One of them, he is the CEO of a large marketing company. One of them is working in the Danish Ministry of Finance. And the final one, he's working with the artificial intelligence and did his degree in computer science. So if I have any questions or concerns within those areas, then they are my go-to guys. Then my investment strategy is based on some principles that have been there all along and continue to be here. So I focus on macroeconomics, identifying and evaluating what kind of growth rates I think different pockets of the global capital markets can have over time. I scan for and analyze mega trends. So these are trends that can grow by more than 10% per year for more than 10 years. Then I focus on fundamentals, conducting very careful company analysis, looking at the company's financial statements, their management teams, their products, their services. What's it like to be a customer there? If they are, have corporate customers, who are their customers? They have some suppliers, who are their suppliers, and so forth. Then all of that I put together to assign a value to the company. What do I really think this company can make in terms of profit year after year? And what is that really worth paying for today? And then I want to buy companies that I evaluate are worth a lot more than their price would indicate. And there's a good quote by Warren Buffett, which is that price is what you pay, value is what you get. So I'm trying to identify companies that have a high value with a low price. Then I focus on the long term. That's the most counterintuitive one to really understand, but that's where I think the most value gets overlooked and thus not priced in. There's a quote by Benjamin Graham, who was sort of the mentor of Warren Buffett, and he said that in the short term, the market is a voting machine. In the long term, a weighing machine. So in the short term, it's very important what people think, other people think. But in the long term, if a company actually does succeed and becomes very big, selling lots of products at high prices, then being an investor in that company will turn out to be a really good thing. Then I focus on risk management, diversifying carefully across many different industries, geographies, and business models. I hedge against, very extreme risks. So if there's any sort of thing that that could happen, that could really do a lot of damage to the whole portfolio, then I want to have a few instruments in there at least that could do well in such scenario. And I stress test to take care of that and ensure I have my hedges in place and my diversification would work in different kind of extreme scenarios. Finally, I focus on keeping the fees low. That means I don't use any leverage, I don't trade any high fee instruments, and I don't do any day trading. I, effectively try to buy something and hold it forever. Although on average, my holding period is 2 years and 7 months. But I don't buy anything with the expectation that, oh, I'm gonna sell it tomorrow or I'm gonna sell it next month or something. I buy something because I think that thing is worth paying the money for, because this is a great company and I'm getting to buy a share of it at a really attractive price. Then there are some areas where I see great opportunities. I like companies with organic growth. That means that they are selling more products, they're managing to increase the price more than the prevailing inflation rates. But it does not include companies that are just growing through acquisitions. So sometimes in the beginning of an annual report, you can read that, oh, we grew revenue by 2% this year, but actually that's just because they acquired another company. The core business actually shrunk by 4%. So what they've achieved is really not that impressive. There are, however, some companies that have really effective acquisition machines, and they're able to acquire companies at attractive prices and then build a lot of growth on top of that acquisition. And that growth built on top of the acquisition, that does count as organic growth, and I do like that. Then I like companies that are resilient, that have strong, sustainable competitive advantages or an ability to build those over time, that have strong balance sheet, and that can finally potentially protect my portfolio from one or more extreme negative scenarios. Then I like companies that are truly profitable, that are creating real value, and are able to ideally reinvest that value into themselves to grow it even further over time. Then I like to invest in companies when they have a new, good company strategy, because that sometimes means that you get to pay the price of the old strategy, but you get the value of the new strategy. It's not enough that a company, they go out and they say that they have a new strategy. I have to see some sort of real bold steps that prove to me that this is really happening. So, if you change the name of the company, sell off a big part of the company, and then really invest heavily into something, that's like telling me that this is a real change and this is a real new strategy. But if I don't see those things, then yeah, potentially it's just sort of an SEO saying there's a new strategy, but they're not actually going to do anything significantly different. Then I like companies that make great products and great services, because quite often the company with the best product and the best service will win over time. But a lot of people, they cannot really identify which is actually a good product and which is actually a good service. So, a classic example of failing at that was when Steve Ballmer, the former CEO of Microsoft, he held up the first iPhone and said, oh, it doesn't have a keyboard, it's too expensive, business users won't want to use it, and I'm very comfortable with our position. And he was, of course, proven wrong by the massive success of the iPhone. But that was an example of actually holding the blockbuster product in your own hand and not being able to see that this is a blockbuster product. And many people have, in the past years been doing that mistake with Tesla. And probably right now, people are also looking at some of NVIDIA's products and going, oh, is that really that great a product compared to some other things? You really have to understand which one is the blockbuster product when it's right there. If you're a smart shopper, you're able to go out and buy the right product for yourself and compare products and see, is this worth paying more for? Is that worth getting a discount on? What are really the key features here? You can really evaluate if you cannot evaluate what is a good product, then you can also not really evaluate what is a good company. And yeah, you have to be able to do that in order to know which companies are really worth investing in. Finally, I like companies that are mission driven, not just because I sometimes believe in the mission, but because having a good mission for a company can be a great way to attract and motivate some of the smartest, most hardworking people without necessarily even having to overpay them. There are some companies that are just magnets for talent. The smartest, most hardworking people, they just want to go work there. And then there are other companies that just, even if one of the smartest, most hardworking people manages to end up there, then they will, within a few years, look to get away from there again, unless they're getting really overpaid. And whether a company is sort of a magnet attracting talent or a magnet repelling it, it might not show up in the next quarter results, but a couple of years down the line, it'll probably show up in the financial statements as well. Then my portfolio on eToro is almost entirely invested in stocks. And I also have a property that I rent out, and many people are probably in that same situation as well, that And that makes good sense because historically stocks and property have been the two biggest and best investment categories. Um, Bonds have historically been good as well. Well, bonds have actually been a bigger market, but um, going forward at the current prevailing interest rates with the current inflation expectations, they're probably not that great. Commodities have historically not done much, although in the more recent decades they've done better. And finally, currencies have historically been terrible. I think they're currently terrible, and they'll probably continue to be terrible. And so whenever I have any excess cash, I generally like to get a transition to the left of this chart and ideally into some stocks. Then there are some factors that really drive the world economy over the long term. I like to split it into the physical realm, the social realm, and the technological realm. So within the physical realm, our natural endowments are very important. How many trees are in different places, how much oil and different kinds of metals are in the ground, and so forth. Life is important, animals, but predominantly humans. The companies that have the right product for the right age segments in the right locations where the demographics are changing in a certain way, they'll have an advantage. Then the realm in which the most value can get destroyed or created the quickest is in the social realm. If you have a document that proves you own your house or a US dollar bill or some numbers on a screen that prove that you own a share or anything like that, then that only has value because we trust that this has value and we trust that other people will believe in those social constructs. And if that trust falls away, then a lot of value can be destroyed very quickly. However, having that trust in those instruments can allow humans to really cooperate with one another, make agreements with one another, and that cooperation is what really creates a lot of value year after year after year. At the most extreme, if people really don't trust each other, you would have the situation where someone comes down to buy a hamburger, and the person working at McDonald's would say, I don't want to give you the burger until you give me the money. And the person with the money would say, I don't want to give you the money until you give me the burger. And then you cannot have any cooperation. And so it's that's a very sort of specific example of that. But ultimately, trust enables cooperation. And it's really, really amazing how much difference that makes in different countries for value creation over time. Then finally, that what we value as humans can change over time. So if you have a house, it's made of brick and mortar and it's really tangible. And obviously, a house has value. But really, if we humans all wanted to live in tents and we all wanted to be outside and nobody wanted to live in houses, nobody wanted to look at houses, then houses wouldn't have any value. And what we humans value can change over time. And so if you see something changing rapidly, even if it's in a niche part of society or it's changing at a low rate, but it's everywhere, then getting in at the beginning of that can be the basis for very, very amazing investment. Then finally, there's the realm of technology. Chief of these, the big technological foundational revolutions. So going, from hunter gathering to agriculture, getting the industrial revolution, getting the internal combustion engine, then going into the electronic era, the digital era, and now potentially we're living through another foundational technological shift in AI. Besides that, there's also from all the way in the deepest pits of the R&D labs where people are coming up with brand new scientific discoveries, all the way to how people in their homes are finding slightly smarter ways of using their products, or finding brands they like a little bit better, and so forth. All of that spectrum, there's great innovation, and some companies you can find are just constantly doing things a little bit better over time, constantly getting a little bit further ahead from the competition. And there are others where the opposite is the case, and whether a company is in one or the other of those scenarios can really make a difference a few years down the line. Then from those big drivers of the global economy over the long term, we can sort of zoom in on where the world economy is today. So in terms of growth, the world is now in an okay place. Growth is not amazingly high, especially not in the EU, where we're sort of standing a little bit still, and pretty good in India, although it's not so evenly distributed across the different demographic segments of India. In terms of unemployment, we're sort of back more or less to where we were before COVID, where the EU has generally over the past many decades had about this much more unemployment than the US, and we're sort of also having that right now. So those are not just some sort of cyclical issues because people prefer Teslas over Volkswagens. There are some more sort of structural issues that are causing the EU to have a lot higher unemployment rate than the US that we really need to deal with. And then basically every region has their own type of unemployment issues that they really could work on to get some even better numbers. In terms of interest rates, these have come a little bit down now and are sort of at an within the a band of normal. I think we have to say effectively if you look at inflation has now come down. That doesn't mean that prices have come down. Inflation is of course the change of prices over time. So inflation is now getting close to target, and so central banks have in general said that it's more important now to fight any potential future unemployment than it is to get sort of inflation back down fully to 2% and not just almost down to 2%. And there's some economists that think that perhaps having a 2% inflation target is actually too stringent, and maybe if we had done this whole decision of a target inflation rate, we would have picked something like 2.5%. And so maybe sort of we are in a world where we maybe have to expect more 2.5% than 2% as sort of the long-term guideline. Then there are some mega trends that I've identified as extra interesting. So if a company is riding on the wave up or driving one or more of these mega trends, then it's more likely to be found in my portfolio. So firstly, I like the nice to haves. When we humans, we have it all. Then we like to compete with one another in fun games and in who can look nicer with their choices of fashion. And hopefully we can get to a world where this can take up much more space in society, and we can all live easier lives focusing on these very enjoyable things that people are truly passionate about. But the nice to haves cannot really stand on their own. They can only stand on the shoulders of the need to haves. So the companies that are developing the products that we need to keep our societies secure and enable us to make our own decisions for ourselves rather than let dictators out in the world come and dictate to us, those companies are to be found in the portfolio. And finally, I like my portfolio to be more or less energy secure, so that the companies in my portfolio that are using a lot of energy, they are sort of using an equivalent amount of energy as the companies that are producing energy in the portfolio are delivering. And finally, there are the enablers and accelerators. So the things that really help us do these other things faster, better, cheaper. Chief of these are the companies driving the artificial intelligence boom, and chief of these, NVIDIA. And finally, the companies that are making the next generation of amazing devices that we'll be using in the future are to be found in the portfolio. Then, if you have found a group of companies, maybe companies in a specific industry or that have some other common characteristic, and you want to have a quick overview of how these companies stack up, a great way is to look at some of their multiples. So this is an example of the Magnificent Seven, so the 7 large American tech companies. And if we start in the top left corner, we can see that in terms of profit margin, they're all doing quite fine, but Tesla and Amazon are certainly lagging quite a bit behind, and NVIDIA is certainly quite far ahead. In terms of growth, we can also see that they're all doing quite fine, but here Apple and Tesla are standing a little bit still, and NVIDIA is, in a complete league of their own, growing at an absolutely insane rate. Absolutely never seen before for a company of that size. The 2 top charts, the higher the better, because they're effectively about profitability and growth. But the 2 bottom charts, the lower the better, because they're effectively about price. So at the bottom left corner, we can see that for every dollar of profit that Microsoft creates per year, we have to pay as investors in aggregate $28 to get our right to that $1. And that's sort of okay, especially since they're also growing over time. But for Tesla, we're paying $120 for every dollar of profit. So we only want to pay that much more for Tesla if we really believe, they can get that growth rate back, or that, can get a higher profit margin or something like that. Otherwise, we wouldn't want to pay that much more for Tesla. Finally, at the bottom right corner, we can see that for every dollar of revenue that Microsoft has, we have to pay $13 in aggregate when we invest to get a claim on that $1 of revenue. And that's sort of quite fair, because if you look for Microsoft, they're also making 44% profit out of that revenue, and they're growing that over time. But for a company like Nvidia, we're paying $37 for every dollar of revenue. But they're also growing at very fast, and they're also getting a lot of profit out of that. For Amazon, however, we are only paying $4 for every dollar of revenue. So that's some very cheap revenue, but they are also not getting that much profit out of that revenue. So that's sort of a way with the multiples to get an overview of a group of companies. Then I use a lot of data to make my analysis of companies, and it often looks something like this. There's data that comes in automatically from all my data providers into my financial models. And then there's data that I create myself, which is numerical. So, it's numbers, but it can be subjective. So something like, how much do I like this aspect of the CEO on a scale from 1 to 10? That's subjective, but it's numerical. And thus I can use that together with all the other numbers to assess the value of companies. Then I use all that data to make my analysis. That means valuation. So valuing how much I think all the different companies are worth. I do that to more than 2,000 companies, and then I focus on slightly less than 200. And then I have 54 companies in the portfolio I've invested in. And then I do risk scenario analysis. So evaluating how much profit these companies could make under different extreme scenarios and likely scenarios, and then put together the companies that are the most valuable compared to the price in a way that makes risk-wise sense. Then all those analyses are used by me to make my decisions. Now, those can be either research decisions. So I see a company that I think could be very interesting, but then I need to research a lot about that company. And for every company that I research, I usually learn something new because there's something special about every company. When I many years ago, for instance, researched Facebook, I didn't just learn about Facebook and that Facebook was an amazing company and that they potentially had a very extraordinary future. I also learned about the concept of social media marketing, and that was like, oh, I wonder what kind of companies are marketing on the internet nowadays. And then, oh, okay, so like this is smart companies. And then forever on, when I made valuations of other companies, I made sure to have a social media marketing component of that valuation. And so with every company that I've analyzed, I've sort of learned something, and then I use that to then evaluate all the other companies as well. And then whenever I see something new, I have to learn a lot about, then it takes some time to learn about that. I have my list of things that I know and things I should learn more about. And so I'm always trying to close those gaps in the right order. And those research decisions then help me, find out what more data I need, what more knowledge do I need, what do I need to change in the way that I value companies. And then those valuation changes might help me to decide what other things I need to look at and learn more about. And as that sort of cycle spins of me researching, getting other data, changing my models and so forth, eventually from that comes my ordering of which companies I should be invested in. And whenever that's not equal to the companies that I am invested in, then I make the necessary changes to bring those in balance. And so then if you add up all those investment decisions over time that, I should be adding more to this position, getting rid of that position, adding this new stock to the portfolio, just add up all those decisions, then that is my portfolio today. And if we look at my portfolio today, it's 54 different assets, with the largest one typically not making up more than 7% of the portfolio. The largest positions are now Nvidia, TSMC, and Iberdrola. And if we take and compare my portfolio's allocation to the US economy, we can see that in the US, it's not just one industry that's creating all the economic activity. There's economic activity and great investment opportunities across many different industries. In my portfolio, I'm extra invested in tech, climate and renewable energy, defense, aerospace and defense, metals and mining, and financial services. If we look at the geographical allocation, we can see that for the world, America makes up about 44% of the economic reality, Europe 21%, Asia 25%. In my portfolio, however, I'm slightly more invested in North America, slightly more invested in Europe, and less invested in Asia, specifically much less invested in China. Then that was my presentation. Thank you very much for watching. I'm now going to go through the many questions that I've received in advance. So firstly, what do you think about TSMC? So I think this is an absolutely incredible company. There's no one who can do what they do. And I think it's going to be very hard for anybody to really compete with them, whether that's Intel trying and failing or, China trying to set up their own rivals. I think that's going to be incredibly difficult. I think they obviously, being from Taiwan, have a huge geopolitical risk with China wanting to take control over Taiwan, and that that could lead to an absolute disaster for the company and the world. However, if that doesn't happen, then I think they'll be able to increase their prices and their production volumes over the next years based off of the AI boom and make an absolutely ungodly amount of profits. What are your thoughts on AI stocks, including TSMC, ASML, ARM, AMD, and Intel? So out of these five mentioned, I think four of them are really amazing companies. I think missing from this list is really Nvidia. And in the portfolio, I have Nvidia, TSMC, and ASML. And I think compared to I think what they will achieve over the next years, the current prices are ridiculously low. How many positions is optimal? So this is a question about returns and risk. And that's sort of actually the key question for a lot of aspects of investing. So if you only have one single stock, and that's the stock you think can do the very, very best on average across scenarios, then you are maximizing for average return in all the futures. So if you imagine there's a multiverse, there's a million different Jeppes in the future, and we only have the one stock that does the best on average across those, well then that's very good on average, but there'll be a lot of those futures where Jeppe is very unhappy that that stock got absolutely hammered because the CEO died, or suddenly a competitor disrupted them, or something happened. So then you say, okay, even though that one stock that's the best stock would be really nice to get that maximum average return across futures, you really want to diversify, having many different companies in different industries, different geographies, and with different business models, so that in all of those different futures, it's looking good in not just in like the half where it went well for one particular company, even though that was the best one on average. And then if you have, say, 100 different companies in different industries, geographies, and with different business models, then adding that company number 101 does almost nothing to your diversification. It's barely noticeable in those different scenarios, whether you had that tiny little bit of return extra or not from having that. And hypothetically, if you remove one company, say the worst of those 100 stocks, and then you take that 1% you allocate to that one stock and put it into your very best stock. So that very best stock now goes from being 1% of your portfolio to 2% of your portfolio. Then if that company really, really becomes the biggest success of all time, then you've doubled your return from that. And that can actually impact the portfolio in many of those futures. And so then you're sort of skewed more towards that other end. I think ideally, if you could have something like just 10 to 20 stocks, then that's very, very fine. And you can also have some stocks where the stock itself is, working in many different industries, in many different geographies. So there's a lot of diversification built into the stock itself already. But sometimes you get an opportunity where you say, actually, I can, add more stocks to get more diversification without really reducing my return by all that much. At other times, you have an opportunity where you say, you know what, if I do this, I can increase my return a little bit, and I'm only taking a little bit more risk, but getting a lot more return out of it. So sort of balancing that, if you have the core answer, how many positions is optimal? According to me right now, that's 54, and that's why I have 54 positions, and that's subject to change. I don't think I'll at any point be having less than 20 positions. I think that's extremely unlikely. I think it's also very unlikely I would ever be having more than 100 positions. But yeah, maybe the future will be different. What is your performance expectation for the next 10 years? I think the next 10 years are going to be absolutely amazing for stocks. Could go in many ways, but I think that's the base case across NARS, is that the next 10 years are going to be really incredible. There are two big factors driving that. Firstly, it's the AI revolution. I think that's going to create some companies of a size and of a profitability that we've just never seen anything remotely similar before. So I think being invested in those companies can really, over the next 10 years, deliver a return of historic proportions. And also then there is the relatively higher inflation rate, because of course when you look at if you have a lot of money in the bank and there's a lot of inflation over time, then that money loses its value. But stocks, properties, and other more fixed assets that can increase their price year after year, write out an email saying we're increasing our prices, another email, we're increasing our prices, they can potentially then increase their their nominal profits, and then the value of those companies when measured in dollars becomes a lot higher. So that's not real value getting created, but it can still lead to a very high nominal return. But AI will be the chief driver of real return, I think. Now it might not work out we might hit a wall, and doing our big trader run, suddenly we might hit the point where, oh, adding a lot more compute, adding a lot more data, letting the training run for a lot longer isn't really increasing the performance on certain aspects much more. But we might also not hit such a wall, and even if we do hit such a wall, we might find ways around it. So probably AI is going to work out extremely well, and it's going to deliver exceptionally good returns over the next 10 years, and maybe even maybe we'll get a big part of that return much faster than the 10 years. How will large-scale natural disasters impact the world and your portfolio? So firstly, if we look at disasters in general, we can say that natural disasters are not the biggest ones. So health disasters are much more important economically and in terms of deaths and pain than natural disasters. So health is way more important. Even something like traffic accidents is more important than natural disasters economically and in terms of deaths. So that is very important to keep that in mind. I think we're going to see many more videos and pictures of natural disasters in the years to come, and we're going to have a lot of sort of like very scary content of people live streaming as they are themselves dying in natural disasters. And that's of course going to be really important for everybody's daily life potentially over the next many years. If you look at the amount and strength of natural hazards over the next years, global warming is probably making that a little bit worse. So we'll see natural hazards, for instance, one of the biggest ones, cyclones. They could have, maybe say 25% over this century more category fives. And so they'll be having higher wind speeds and dealing more economic damage. Or have the capacity to deal more economic damage and the higher death toll. However, if we also look at how we have been changing and have the capacity to change how we respond to and anticipate natural hazards. So a cyclone is coming, it's going to be stronger, but we are also better prepared for it, and we are also better at tackling it as it happens. Then, as we've seen over the past century, actually the number of deaths and damage from natural hazard has gone down quite dramatically, down by like a factor 4, and potentially we're going to see something like that trend continue. So as maybe say natural hazards get 25% worse, we will maybe get twice as good as dealing with them. So the actual economic damage and death toll will be lower over time. And then in terms of how that impacts the world, I mean, natural disasters are overall, of course, very bad for the world. How it is for my portfolio, I think I have companies and will continuously be able to pick companies that will benefit from whatever. And so it should probably be good for the portfolio. How do you plan to trade on the decline of the US dollar and rise of BRICS? So with the US dollar losing value over time to inflation and potentially, not being as secure an instrument for some countries that could get into a conflict with the US, it may face some troubles. And I don't like holding a lot of cash. I don't like holding a lot of bonds that pay me a nominal interest rate in dollars because of this inflation risk. BRICS is effectively, it started out as an acronym for Brazil, Russia, India, China, and then with the addition of South Africa, now it's more of a project that includes some different components, including setting up some international organizations, as well as, potentially a new reserve currency and payments infrastructure and such. And that's effectively, in the West for many years, we've been talking about securing our supply chains, diversifying our supply chains with an eye on, imagine that there's ever a conflict with China and sanctions on China, then, in the West, we want to be ready to, buy things from other places than China. But at the same time, China and many countries that trade with China, they also want to be prepared and diversified and ready for such a decoupling of such a conflict and such a sanctions on China world. And so if you are, say a country like India, and in whichever way the world works, you're going to want to continue to buy oil from Russia, you're going to want to continue to sell products to China and buy from China, you need a way to pay Russia, a way to pay China and receive payments from those and so forth. And so some of these countries, they are setting up a parallel system to the US dollar system to be able to trade with one another in the case of sanctions. And I think that's sort of that whole system, if built out perfectly, is not directly of itself a rival to the US dollar. It's not as strong as the US dollar, but it's there as sort of similar thing for, a big part of the world continue to trade in the case of a conflict. What topics and data will you focus on during the next 6 to 12 months? So the absolutely most important ones are AI and geopolitics. In terms of that's in terms of the topics. In terms of data, I will be looking at the most important numbers for those topics, as well as macroeconomic data, company data, and so forth. What do you think about the cybersecurity sector? I think cybersecurity is extremely important. I don't, potentially at some point we're going to see a cybersecurity disaster where, a really, really major cybersecurity attack of a magnitude that we have not seen ever. And, that could be, that's sort of a, given that I'm talking about it, we can't technically call it a black swan, but a major, major cybersecurity attack could really change the world. And that's something that, all the largest organizations, governments, and companies really have to consider. And it's one of the biggest threats to any large corporation or country as well. So we're going to see companies and countries spend more on cybersecurity going forward. But the companies that are delivering the best services and tools for cybersecurity, they're also in quite tough competition with one another. They're not making that much profits. They're not growing that much, and they're very expensive. So there's none of them in my portfolio. I used to have Checkpoint, but yeah, currently I don't think they're the best investment opportunities, despite the overall attractiveness of the industry. Can you share your historical assets under copy numbers? So now it's at 97 million US dollars. Historically, it's just been going up and down with the market, but then with a steady sort of upwards trend. So I remember when it hit 20 million, and then 50 million, and 75 million, and 90 million, and yeah, the next milestone for me is of course the very exciting prospect of soon hitting 100 million. What do you think of Pacific Biosciences of California? So I've invested in this industry many years ago. One of my friends was studying genetics at Oxford University, and we discussed this industry a lot. And I finally invested in Illumina and did very well on that one. They tried to acquire PacBio, but didn't manage to. And I think since then, sort of, there's more competition. This is not something that is in my portfolio right now. Yeah, I think it was very exciting and new back then, and now potentially it's sort of yeah, it could be, prices are high, I think. Will you short the market? So in general, I don't short sell, and I'll explain exactly why. The market has historically on average gone up by 7% per year. So if it's going up by 7% per year and you just pick a random stock, then you're on average earning 7% per year. Now you're earning 7% plus your luck plus your skills. So if you're very lucky but not so skilled, maybe you'll be at the 7%. If you have your 7% and you're very skilled and also lucky, maybe you'll have higher than 7%. But that's fundamentally very good that you have this 7% wind in your back, constantly. So even if you are, a bit unlucky, or maybe you only made 2% over a, long period, or maybe you are. But when you're shorting, the opposite is the case. You are on average losing 7% every year. So now, even if you're really, really good at short selling, you identify the right ones, you short them at the right time, you have the 7% fighting against you. And that's why someone like Bill Ackman, despite being potentially very good at short selling, ended up with a reasonably mediocre return for a long period. And now he doesn't short anymore. And there's also why a lot of the best investors don't short. And then you have other issues as well. When you're shorting, you actually pay fees to keep open the short position. That's further working against you. Then when you're buying a stock, a long position, you have something called limited liability protection. That means that if the stock, gets into stops making any profit and gets into huge debt, the company will declare bankrupt and your stock will be worth zero. And then that's that. You don't lose any more than that. It's just you lost the money you invested in that company. The rest of your portfolio can be fine. Just that one stock wiped out. But there's no such limited liability protection for a short position. A single short position. Imagine someone putting on a huge short bet on Nvidia as a large part of their portfolio. Then there's no limit to how high up Nvidia can go, and you will be losing from all of that. And you can end up with such a negative position that your whole portfolio is wiped out from that single short position. That's actually putting a lot of risk into your portfolio. A lot of people sometimes put in some short position thinking they're reducing the risk of their portfolio, but they're really just changing the shape of their sort of risk profile in that, in most typical cases, they will actually have more stability, but in extreme cases, now they've added more cases of total loss for their portfolio. And then yeah, that's effectively the core reason of why I don't short sell and don't generally recommend men short selling. If eToro adds put options, for me, potentially that's something I would consider, because that's a different way of shorting and that can actually be quite useful. Should we sell before the market starts to decline? So got multiple different variants of this question also regarding a potential upcoming recession. So effectively, there is this saying that pessimists sound smart, optimists make money. And that's been very much the case historically in markets. There are a lot of people who are always predicting a recession, saying, "Oh, I don't think it can go up anymore. Now it's gone up for a long time." Well, yeah, but it's been going up for a long time. That could also tell you it might continue to mostly go up. If you look at sort of over the course of a century, the worst that happens is the market goes down, by you lose half, but then you double and you double and you double, then you lose half, then you double and you double, then you lose half. If you just add that up over a long period of time, you get to that 7% average positive return. You don't get to an average negative return. That's why on average, you want to stay invested in the market. And even if there's an elevated risk of recession, it might still not be a great time to, try to jump out of the market, especially because probably that's already been anticipated by others as well. So it's not just that you are able to predict a recession, you have to predict it better than the weighted average expert, which is really, really difficult. And so, even some of the greatest economists cannot really find excess return from trying to predict when the next recession comes. And so it's sort of a futile exercise, and on average really, really bad to either sell everything or be shorting the market whenever you think things are about to get bad. You will succeed with that some of the time, and then you will fail with that some of the time, and then when you add that up over time, you'll just have overall made less money. What is the likelihood of a Santa rally this end of year? So I generally don't invest based off of what I think is going to happen, with sentiment amongst investors over the next few months. I focus on buying companies that I think will, over the long term, become really, really big and profitable, that I can buy at a good price today. And then I'm very happy to wait patiently for that to happen. Now, on average, more markets are generally more likely to go up than down. So it's more likely that we'll have a Santa rally than that we won't. But I wouldn't want to invest my money based off of what I think others will think next month. I think people are wrong about stocks today, and I think they'll also be wrong next month. And I don't really invest based off how I think the way they are wrong will change over the next month. I base my view off of how I shall be proven right over many years. How has your performance been in the past 3 years relative to the key benchmarks? So my performance over the past 3 years has been really, really good. If you look at most investors on weighted average, they'll have been spread out across many different geographies, many different industries, with too little invested in America, too little invested in big tech. If you had invested only in the S&P 500 and NASDAQ, you would, of course, also have done very well. But it's important to note, if you invest only, for instance, in S&P 500, then you are only investing in American companies, and with a very, very large proportion invested in big tech. So that's sort of risk-wise not the most sensible, I think. But over the past 3 years, yeah, S&P 500 and NASDAQ in my portfolio have done incredibly well. And there's a lot of investors that have managed to not do so well because they were trying to do more equal weight within America, doing a lot more emerging markets, and being underweight tech and so forth. And yeah, well, of course, turned out really badly for them. When will you create courses about investing for beginners? So that's certainly something that could be interesting to do. I do like explaining how things work. And I think the current courses out there are not so great. So there would be definitely a great need to build this. But there's also a question, I very carefully prioritize my time on what I need to research, what activities I need to engage in, and so forth. And I put into my, very smart system for organizing my time, how valuable I think creating course about investing is, how much time I expect it would take me, and then modify with a lot of different factors. That's, in my calendar system, probably going to happen sometimes in the, end of this decade, which is then, of course, not so exciting to hear for someone hoping for an investing course from me. Yeah, maybe things will change and I will want to do a course about investing, but right now I don't think assigning me and my team's time for that is really the most valuable. I want to just really invest my own money in the best way that I can, and then people can copy me and invest their money in the same way. And I just want to focus 100% on that. And then, I don't really need to have a plan B. I don't need to do some kind of other thing. I'm just going to do only this one thing and do this one thing really well. How do you comment on Berkshire Hathaway's massive cash pile? So it's certainly larger than usual, more than twice the sort of past 10-year average of how much cash they hold, but they're still predominantly invested in companies. So their cash pile is how much is now 300 billion out of like more than a trillion. So it's like about maybe less than 30% of their assets that are in cash. So they're predominantly still investing in the stock market, and particularly the US. If you look at sort of their portfolio and say that, okay, I believe their portfolio shows me what they think, then they still think that being invested in US companies is the best. And why they're increasing their cash for a little bit, it could just be random timing. It could also be because they want to be a little bit risk off, but it's sort of, it's not, if they had sold everything and were only holding bonds now, if there are no stocks, I think that would certainly be saying a lot more than that they're just having a lot of cash, but still having a lot more invested in companies. What do you think about ESG scores? So I think these are worse than useless. I reviewed many ESG scores from different providers, and very often, if you look at each of the three, environment, social, and governance, they're wrong on at least two and maybe all three of them. There'll be very often where it's like you get a good positive ESG score for a company that's, in my view, really not a company you would invest in for ethical reasons, whereas a company that you would definitely want to invest in and support for ethical reasons, they're suddenly getting a lower score. So if you just take a random selection of stocks, I think you will have a more ethical portfolio that is better for the environment, better, for engaging in, social with communities and with better governance than if you follow these ESG scores. So that's unfortunate. It would be great if the ESG scores work, but they really, really are less than useful. What are your thoughts on bonds and gold? So very different assets. I right now don't like bonds at all. I always look at the bonds for all the different companies that I consider investing in and invest in to see, what are their, what are the details of the bonds, what interest rates are they paying and so forth for the different durations. And then I look at them and I just go like, right, this is just way less attractive investment opportunity than buying that same company's stock. So you would just be like, you're just earning so little on that bond compared to how much profits and growth that company is delivering that it's just, for me, not worth at all to be holding any amount of their bonds. So yeah, I'm really not excited about bonds at the moment. But I mean, my last name is Bond, so hypothetically, one day maybe I could be focusing on bond investments, but I think certainly I wouldn't want to do that today based off of the interest rates that I'm seeing out there. Gold, I think gold is a great asset. It's a great asset in the way that it can protect in some really extreme scenarios. If suddenly there's hyperinflation, then return maybe to the money we knew before the current era. Gold. It's also, beautiful. Many people love to use it for different things. So that puts a sort of floor under its value. Now, many central banks like to have a bit more gold to, create a little bit more confidence in their currencies and be prepared for potential negative future scenarios. And then you have this question, well, how should I hold my gold? Well, should I buy some gold jewelry to wear around that could get stolen? Should I pay a lot of fees for, a fund where they keep the gold stored safely in a vault in New York City with lots of guards where I'm paying a lot of money to store my gold year after year? I think the best way is to just buy gold mines. Now, they have a lot of gold stored safely in the ground that they can mine. They'll have equipment. They'll have the opportunity to open new mines. They'll have an inventory of gold that they've, agreed to sell at certain prices. But, that after that, those run out, they can sell it at whatever market prices prevail. So I think if you sort of say, 20 years from now, I want to have a lot of gold. How can I have the most gold? And I think the way you can get the most gold the cheapest is by investing in gold mines. And here specifically, Barrick, I think is the most interesting one, the one that I have in my portfolio. What is your opinion on Vale? So that's the Brazilian iron miner. I think that they are sort of in the case that they are a great player at a very attractive price, but in a quite tough industry. There is a lot of competition in iron mining, and in the core use of iron is steel, and the core use of steel is for construction, and construction is potentially globally slowing down, especially construction in China, and that's sort of a hard hit. But I still think within that Vale is making a lot of profits, and they'll continue to be able to make a lot of profits. And I think compared to the price we're paying, that's very attractive, a very attractive investment opportunity. What do you think about Palantir? So I think that's one of the most amazing companies in the world. I remember following them since the very founding. I was sitting ready at night during the IPO to make my investment right as they IPO'd, and that's obviously been a massively successful investment for me. And I think now with them, they have a great in with the Trump administration and the people around Trump now, and so potentially there could be even more government contracts coming their way. And I think a lot of companies and a lot of just customers really love using Palantir products, and I think that's they have a unique position, and they can really utilize that over the next years to create much a higher level of profit for themselves, because that's sort of what's missing right now, is that they have a great product, they have a lot of customers support, but they also need to make a lot more profits from this. So that was the questions, and thank you very much for watching, and let's have a great quarter.